Hi, folks. Good morning. Nick Muldoon from Easy Agile here. I'm super excited to be joined by Gareth from Scendar this morning. The reason for this quick chat with Gareth is because I wasn't able to attend SaaStr in the Bay Area, the conference over there earlier this month. Indeed, I've never attended the conference, and I've often wanted to go. And so in this conversation that I was having with Gareth last Friday, as we were kind of finalizing the FY23 accounts for Easy Agile, I just got a little bit of a taste of what Gareth picked up at the conference earlier this month when he went over there with his team. And so I wanted to take some time to draw some of those lessons out of him and share them with the founder community, bootstrapped or otherwise, and anyone that's in the finance space in a SaaS company, and really kind of share some of his learnings. Before we jump in, I'd like to acknowledge the traditional custodians of the land upon which we broadcast today. They're the people of the Dharawal speaking country. We pay our respects to elders past, present and emerging, and extend the same respects to all Aboriginal, Torres Strait Islander and First Nations peoples that are joining us today. Also, vote yes next month. Okay, so to Gareth. Gareth Bryant, Scendar, he's the managing partner there. He's been with Scendar for a decade now.
Yeah, 11 years.
11 years, love it. So Gareth took a few of his team from Australia over to the Bay Area earlier this month for the annual SaaStr event. And as I said, it's a conference I'd love to attend. And I believe it was your first time, Gareth.
It was my second time, actually. It was the second time. Yeah, we went last year as well.
Okay, well, I mean, that says something. If you went once and you went back again, you're obviously getting value out of it.
Absolutely.
So Scendar is an accounting firm. They're based in Sydney. They're our accounting partner at Easy Agile. And they've got operations in Sydney, Melbourne, and London, if I'm not mistaken. But
soon to be on the last one.
Soon to be London. But they've got a fair chunk of clients that do business in Australia and the US, and that's Aussie companies that are going to the US and US companies that are coming to Australia. And so let's dive into it. Gareth, thanks so much for joining me.
Mate, thanks for having me. This is a pleasure.
Okay, this is exciting. So I guess the big question for me and what I want to dive into is kind of like uncertainty, and there's uncertainty from founders, there's uncertainty in the macroeconomic environment. I guess I want to get a sense from SaaStr, like how are the folks at SaaStr seeing the market? Are we all feeling the pain, or is it isolated?
I think this was the biggest surprise for me, is that we work with a lot of SaaS businesses. And so we've been feeling the pain through them over the last year or two, right? Like probably the last 18 months, as the markets have tightened, as interest rates have gone up. And I think when I was on the plane and I'm sitting there and I'm like, I wonder what the vibe's going to be like. And I was expecting it to be a little bit down, a little bit, where everybody's been feeling the pain. But actually it was quite the opposite. I think, they're quite optimistic. We feel like, or they feel like that, all the speakers and the presenters and things there really feel like the bottom has been hit in the US market in particular, and that we are starting to see a slight bounce up overall. So, obviously we can then, kind of divide that into kind of, funding, which is still really tough. I think the exception being AI companies, but probably dive into that a bit more later. But, seed to Series A, I think there was a stat thrown out that, in the highs of the bubble of 2021, kind of 80% of companies who raised a seed got to raise a Series A. And so therefore 20% attrition. And now that's kind of flipped on its head, right? Where companies going from seed to A, it's like 20% of companies are making it. 80% are either dying or raising bridge rounds and just trying to stay alive long enough for this market to recover. So that's kind of
in 2021. I'm interested to know, like in 2021, where you're saying there's 80% that went from their seed to their Series A. I mean, that was an outlier. And so is this a reversion to the mean? Like, was it 20% that got from seed to Series A back in 2020, 2019, 2018?
I think it's gone, the shock, if you will, as opposed to a downturn, has gone a bit the other way. So I don't think it's quite 20%. Like, I don't have absolute stats right in front of me, but I think you'll find it's slightly higher than that. Like when we get back to, or I don't know if we'll ever get back to what is normal. I don't even know what is normal these days, but I think it should be, there should be like a higher percentage getting to Series A, right? Like I would think it would be in the 30-40% range, but obviously with, how bubbly it was in 2021 and all the cash flying around, is that we've kind of snapped back the other way. Everybody's got super conservative and not risk taking, despite the fact it's in venture capital, which is by its nature risk taking, right? But I think it's like it snaps back hard and then it'll start to creep up again. That's the gut feeling. Yeah.
So it like, I guess, like, are there like green shoots or rays of sunshine? I'm thinking about this month with the Instacart and the ARM IPO, and maybe that's kind of an indication. But were you seeing, or were there any significant raises that were announced or that you heard about during the conference?
Sorry, Nick. So there's the 3 IPOs, right? So there's the ARM, there's Instacart and Klaviyo, right? Who went, it was a Shopify kind of software, adjacent product, right? And they've all gone and hit the market. Like their IPOs were all in the last couple of weeks. We've seen various results of what's happened after that. There's a pop and then there's a drop and all those sorts of things. But that is naturally instilling confidence in the US market, right? How that flows through to Australia, time will tell. But they are expecting a heap of these other companies, these really large privates, right? So the Stripes of the world, for example, there have been, they, what would have in a normal market, they would have IPO'd, sometime in 2022, most likely, or early 2023. They obviously held back, these 3 IPOs were the first ones since December 2021, right? Which is an incredibly long period of time. But I think like that instills confidence on the funding side. But I think even now that we've seemingly, the commentary from the Reserve Bank of Australia, from the Fed in the US, is that we've kind of hit, there might be one, maybe 2 raises to go, but we've effectively hit.
It's kind of,
it's leveling off, right? I think is the term that I would use it from an interest rate perspective. And I've been saying this too, and I'm definitely not a crystal ball type person normally, but I have been saying to our founders is that once the market has certainty over where it's going to finish, confidence will start to come back, right? People inherently want to be optimistic. And I think business decisions, and spend decisions start to free up. People, are encouraged to invest in growth again. And, and it's then just pushing the snowball down the hill. So I think green shoots, yes. I think another to kind of, quote, a much smarter person than I, David Sachs was, commenting on this at SaaStr. And he was like, expect the next 12 months to be better than the last 12 months. How much better they are will depend on your vertical, on market conditions, etc. But it won't be worse, right? And so I think we can take a lot of, I guess, comfort in that, and we can try and move forward.
Yeah, okay. And so, we talked a little bit about listings. I'm interested to know, and maybe did David talk about the multiples, that companies are going out and raising? And I guess we're in a slightly different situation because we've been bootstrapped and we haven't raised and we don't really have exposure to that. But for these growing private companies, like, are they going to get a larger multiple in 2024, or is that kind of plateauing just like the interest rates?
So I think that particular session didn't have it, but there was actually a really good session run by the head of insights from Carter, which people who don't know Carter, the largest cap table, or the kind of the leader in cap table software, right? And so they have a lot of data, right? And so there's a data-driven approach to rounds and things like that. But I think what we're seeing now is that it depends on which level again, right? So don't want to give you it depends kind of answer, but at seed level, the reality is like a normal, when I say a normal SaaS company, I mean a non-AI SaaS company, right? We'll still see like there has been a significant amount shaved off those multiples, right? Like typically a lot of those seed rounds are based on, pure valuation, kind of finger in the air stuff. But rather than a multiple of revenue, whereas Series A and beyond, you're going to get those, the multiples. I think what we saw in 2021 will never be seen again. I still think like a lot of that was kind of contained to the US as well. Like I think those, the 100 times forward looking revenue, or the 80 times or the 200 times, like I think maybe it's just the companies that I work with, but we never really saw that in Australia. I think the VC community here is a little bit more sensible. And I think we did see some high ones, in the 10 to 20 kind of range that we won't see again. But I think, yeah, the multiples have definitely come down, and I think they'll stay here for like considerable period of time, right? So in that 5 to 8, times forward looking revenue, I think, but seed when you're not AI, you're going to really need to show some real traction and early product market fit to get a good val.
Okay. And so I'm just thinking about valuation. So there's, these, like that 100 times forward earnings kind of multiple, like that 100 times ARR multiple. It just sounds wild, quite frankly. But if you were talking about like these massive multiples in 2021, are venture capital firms these days kind of shifting to an EBITDA multiple, or are they still sticking to that ARR multiple as like, are they expecting that you get to profitability, but then why would they give you the money if you're not going to be burning it, I guess?
Yeah, so I think it's like it's a march to profitability. It's what we call it, right? Or even for like a B2B SaaS business, it's not so much initially about profitability, but cash flow positivity, right? So if you're a company that takes annual payments up front, you may not be profitable, but by virtue of taking a year's worth of revenue up front, you can be cash flow positive before you're profitable. Don't really want to dive into accounting here because it's not really that interesting. But I think being able to control your own destiny by being cash flow positive and generating free cash flow is where a lot of the VCs want you to get to, but only while maintaining those growth rates. And I think when you compare your original question of comparing ARR multiples to EBITDA multiples, really depends on how much the company is growing, right? Like I heard an anecdote in a meeting with two VCs sitting at the table, and they're like, well, once you get to cash flow positive, if you're once you get to profitability, there's a high chance you could be valued on an EBITDA multiple. And when we're talking that, we're talking instead of 10 times revenue or 8 times revenue, we're talking 3 times, profit, right? Which is obviously a much lower number. But what that really is showing that we'll value on that, or other investors or acquirers will value on that if you start to grow like a more traditional business, right? So if you're going to grow 10 or 20% or less like year on year, as opposed to a SaaS business, like a venture-backed SaaS business is, the old adage of triple, double, right? So we're talking, 300%, 200%, 150% growth year on year. If you're still growing at those rates, right, there is no chance you're ever going to be valued on an EBITDA multiple, right? It's always going to be, regardless of your profitability status, it's always going to be based on your revenue, because you are hitting those growth numbers, which are incredible. Once you get to kind of, 8, 9 digits, it's incredibly hard to maintain, right? But, the best companies do it, right?
So you talked earlier, Gareth, about like the AI versus the non-AI. Were there any like breakout AI stories that kind of caught your attention at SaaStr?
Not specific companies, but there was a lot of talk. Obviously, it's the kind of buzz thing. Startups are now going into meetings with potential investors, and even if it's a B2B, sales assisted SaaS tool, for example, or something like that, and they're now getting asked the question, well, how are you going to inject AI into this product? Right? It's at the forefront of everybody's thing. And I think what we've just talked about with multiples, when we're talking about AI companies, just ignore it, right? Like it's a different bucket altogether. We're right in the middle of a hype cycle. The valuations are pretty bonkers, right? And I think, again, to quote people smarter than me, I think they said they're expecting over the next 2 years, while we're in this hype cycle, for tens of billions, didn't quantify it any more than that, tens of billions of dollars to be invested in AI. And they're predicting that 90% of it will be lost. Right. Like, yeah. 90, again, not me predicting that, just for everyone out there, but 90% of it will be lost, because we saw it with the start of mobile. We saw it at the start of the internet, like the .com, right? We saw it at the start of social. And let's not even go into Web3, right? Like, there's a lot, everyone, if you
What's this Web3? We're so post Web3 at this point. It's all AI.
We are. The Web3 was the height of the bubble, right? But anyway, it's a conversation for another day.
Oh dear. Okay.
Yeah, like
I'm just
it's really the multiples are crazy. The multiples are crazy and not really realistic. It's more, there's a lot of FOMO with investors. There's a lot of wanting to be at the forefront of this. For example, Craft Ventures, I think they raised 3.5 billion of their funds under management of their last funds. And they said for their seed level investments, which is a fair chunk of it, 80% of that's going to AI, right? Like big numbers.
Wow.
Huge numbers. When you compare that's traditionally a SaaS fund, right? Pure SaaS fund.
This is interesting though, because I think about some of that run up in 2021, surely at least part of it was attributed to the fact that these venture funds had raised ever larger funds themselves. They went from a $150 million fund one to a $250 million fund two to a $450 million fund three. And now, you were getting $1 billion funds that they were raising. And so they had to deploy that capital, and there's only so many good deals that come in. And so naturally the valuations go up because there's a lot of interest from these venture funds in the few good deals that come through. Presumably, if the valuations have come back, these venture funds are now sitting on a lot of cash and they're just not deploying it as quickly? Or are they kind of like opening the floodgates and they're lowering their bar for what they will invest in just to keep getting the money out there?
I think there was definitely a pause. Like 2022 was probably the lowest number of deals being done, like for a long time, right? Probably since the, GFC, I would imagine, right? That's coming back. Like good deals are still getting done for good, and that's what I've been saying to our clients the whole way along. Good companies that can demonstrate traction, can demonstrate product market fit, are still going to get funded, and they're going to get funded at good multiples. It's everyone. It's the people who haven't found it yet. Haven't found the product market fit, haven't found the right, I guess, solution that their customers are going to be demanding. Will struggle to raise like those follow-on rounds, right? But I think I imagine there's still a lot of, dry powder, I think they call it, right? Just sitting there waiting to be deployed. I think there's also a lot of capital, like funds have been committed, but there's a lot of capital that's still to be called, right? And I think the expectation is, because, understanding how venture capital funds work is that you commit to an amount and then it's called over the first 3 years, usually, of a fund, right? And so I think there's a lot still to be called, and whether or not LPs are going to be, so limited partners, in the venture capital partnership, will be able to or willing to commit all their capital that they've, or that they've to put it in, will remain to be seen. I've heard some anecdotes that perhaps, large institutional investors will pull back, right? So it remains.
So they'll renege.
Potentially
renege.
Potentially, like we'll see. We'll see. But a lot of it is now being funneled into AI.
Okay. I want to come back to something that we talked about briefly last Friday, and focus more for the founders. And you were talking about this, I think the term that you used, if I'm not mistaken, was burn multiple. So I don't feel that that's a term that I've heard before, and maybe that's just because of the nature of Easy Agile, but can you explain it so I understand it?
For sure. So the reason you and I haven't spoken about it, despite the fact that we speak, many times a year, is the fact that your company, doesn't burn cash. It's a profitable business. You're quite openly, proud of that, as you should be, which is why I can say it on something like this. But I think for venture-backed businesses who aren't cash flow positive, right? Burn multiple was kind of coined, I think it was around 2021, or just after. And what it is a measure of, it's a really simple SaaS metric, right? It can be used for any business, but particularly in SaaS. And it is, how many dollars of cash are you burning for each new dollar of ARR you're accruing or achieving, right, in your business? I'll give you a quick, really simple example. So over 12 months, if your company was to burn $2 million in cash, which is quite, it's quite normal for, companies that have raised 4 or 5. And in that time, their ARR, they've gotten $1 million of new ARR, right? So $1 million of new ARR burnt $2 million of cash, right? Their burn multiple will be 2, right? 2 over 1, 2. Everybody can do that math in their head, which is why I picked that example. And then there's a scale, right? There's a scale, there's a table that, is kind of deemed as, good or amazing through to bad, right? And so, kind of, it really depends on, or the scale is very much, if you're sitting at 2 is good. 3 or above is problematic, right? The exception to that, though, is for companies that are pre-Series A. So companies that are still building their product, investing a lot of their money in R&D, the money that they, the capital they raise for that specific purpose, they're expected to be high, right? Like if we're sitting here with a company that is still, got a product, where, 80% of their staff are product and engineering, they've only just started turning on the revenue tap, and they're sitting at a burn multiple of 5 or 6, there's no need to panic there. Obviously, runway measurement is important, but once you get kind of past Series A, your product is essentially built, and any tech person out there will laugh at me saying that because it's never built, right? I can see your face.
It's never done.
No, it's never done. I understand that, and as an accountant,
but you've broken the back of it.
Yeah, the predominant, you've kind of got it in market. Customers are using it. Customers are paying money for it. There's still iterative changes and innovation and things like that still coming, but effectively you've gone from 80% of your personnel being product and engineering to maybe 30% or 40%, right? And the rest sales, marketing, operations, etc., right? At that point, you'd be expecting to be under 3 and trending towards 0, right? So for a bootstrapped, cash flow positive business, this metric is not relevant, right? It's not relevant. Yeah. That's a good thing, right? But you'd want to be seeing it trend towards 0 to at some point be, to be a cash flow positive company and eventually a profitable company. But it is a measure that a lot of venture capitalists are looking at now, and we get asked to report it on a regular basis for our companies.
Okay. Were there any other metrics that you heard about last week, or earlier this month, that kind of, new ones or different ones? I think of 2 that I've come across last financial year, and one was the GRR, the gross revenue retention, and we'd previously looked at net revenue retention. And then one of the other ones, it escapes my mind now, but were there other ones that came up?
I think like gross and net revenue retention are a big one. Like I think they're not necessarily new.
No.
Like net revenue retention in particular, but its importance is increasing, right? The ability to, especially in B2B SaaS, the ability to expand your customers, to get them in the door, and to, whether it's seat count or adding features or whatever business
cross-sell
model you have, cross-selling, adding new products for a multi-product company, incredibly important, right? And it's a really good measure of a healthy business if you have, if you're hitting 120% plus net revenue retention, like that is a really good sign. Obviously, any like companies that do far above that are crushing it, right? I think that's one. I think the one that when there was a discussion around burn multiple at SaaStr was what people like about it is it's simple and there's nowhere to hide, right? It is a simple calc of what was your cash at the start of the period, what was your cash at the end, and how much ARR did you add? What was your ARR at the start? What was your ARR at the end, right? So net ARR growth. And there's nowhere to hide. Whereas, one of the ones that kind of got, hammered a bit is, customer acquisition costs, not because it's not a relevant metric. It is. We've measured it for years, and it is always a good sign, a good one to track, and trend analysis and things like that. Is it could be manipulated, right? Should this expense be included? Is it true, cost of a customer? Is it kind of brand awareness, or the brand journey? Can that be excluded? And anything that can be
like, you've actually got to dive into it and look at it in detail to understand.
Yeah, and everyone has their own definition, right? There are, commonly accepted ones, but it's ripe for, and I think it's ripe for manipulation, not in a nefarious way, but just, you and I might have different definitions of what that expense is and whether or not it's directly attributed to acquiring customers or not. And when there's
like, is your head of go-to-market included in that or not? You'd exclude it, and it makes,
or is he part of the leadership team and he's just, it's separate, and examples like that. So I think, that's why they're kind of leaning on these ones that are like black and white and not great. That being said, we still report CAC for all of our customers, and we agree on, the principles, and then we apply them consistently. I think, whenever you've got metrics, as long as you do that, and you come up with the methodology beforehand, not once you see the numbers and then try and tweak it. As long as you come up with the methodology beforehand, you rely on what is industry standard and best practice, you'll be fine.
Is something like CAC actually included in the GAAP accounting principles?
No, it's separate. Like, it's not, because it doesn't come into a proper normal financial report. Like, it's not a P&L, balance sheet, cash flow.
Okay. Yeah.
No, it's very, the SaaS metrics always just sit outside that. Yeah.
Okay. So this was your second year at SaaStr, second time in the Bay Area. What's the draw card for SaaStr for you?
So I think, like, my role as a fractional part-time CFO, right, for a whole bunch of B2B SaaS businesses, is when you're sitting in, whether it's a board meeting or just a monthly finance meeting with the founders and talking about how things are going, you inevitably get pushed into areas where it's not pure accounting or finance, right? So talking about go-to-market strategy, or, fundraising trends, or, things that are kind of just not completely out. Like, I'm not going to sit there and talk about, product marketing strategy, or, the best platform to build your SaaS product on, or anything like that are way outside my comfort zone and areas I don't. But there are those ones on the fringe, like, you, especially around go-to-market, and they're areas that, I'll confess, 2 years ago, I was pretty not ignorant on, but I didn't know enough to have an educated conversation with our founders. And so that needs to change, right? And so, sitting here in 2021, our borders were still shut, and watching it all happen, like on Twitter, on LinkedIn, and kind of getting that FOMO and watching sessions like later on, on YouTube or whatever, but it's not the same, right? And so, being able to widen that knowledge to enhance the experience for our clients, and to bring them more knowledge that they might not have, that they might not get in their circle or their network, is the draw card, right? Getting to talk to people and network over there is a bonus, but it is very much an educational experience. And, there are like hundreds of sessions, right? So it's about picking your spots of, where you spend your time. But yeah, really good experience.
Okay. And so your plan is you'll head back in 2024?
I think so. Like, we've been twice now. There's events in Europe as well that we're looking at, as well, given our, we want to push into the UK, and really,
SaaStr's in London next year, isn't it?
Sorry?
The SaaStr London next year, as well as the Bay Area one.
There's SaaStr London, there's SaaStr, which this year is in Dublin. There's a lot of events. And so, but there will definitely be a Scendar contingent at one or more of those, because like, this area is just something we want to continue to focus on and learn a lot. So talking about putting together a convoy, mate. So you might have to drag you along.
Oh, I'd love it. That'd be fantastic. All right, Gareth. Look, I really enjoyed the chat, and I've taken a lot from it. I'm interested in the burn multiple, and it's just learning something new, I guess, really, isn't it? But also around the And look, so thank you so much for the Cliff Notes from SaaStr 2023. Really appreciate it. Team, I hope you've enjoyed the conversation that Gareth and I have had. I hope you've taken something from it as well. If you have any questions for Gareth and you want to follow up, like hit up the team at Scendar and reach out and find out more. Otherwise, keep an eye out because it sounds like Gareth's going to be leading a convoy to SaaStr London or Bay Area in 2024. So if you want to head along from Australia, reach out.
Let's do it.
Thanks, Gareth.
Sounds good. Thank you.